years crisis.
Exactly.
2009-10, right?
I actually started the week that Lehman Brothers went bust, so it was a very interesting time to be starting. We managed to ride out the storm and we bought some great deals in the depths of the financial crisis.
At least a couple of cycles in real estate, I guess, the 2008-9, which I also saw at Blackstone, and then the big boom that happened from 2010 to 17-18, and then the warehousing boom, which started in 2015-16 with the rise of Amazon and online sales, and which really peaked during the COVID-19 crisis.
We had 3 prime ministers and 4 chancellors in 12 months. Inflation went to 11% at the end of last year. Interest rates rose to 3.5%. But I think investors are beginning to think things are stabilised.
One of the reasons we buy real estate is so that we have returns which are linked to inflation.
Yes.
3 prime ministers in the last 6-7 months, right? There's a cost of living crisis, there are kind of strikes. It's almost reminiscent of the 1970s.
A lot of investors are beginning to see the bottom. I think things are stabilised. Rishi Sunak has been great.
Well, like Warren Buffett says, you know, that's the time to be a bit greedy, and then you kind of see, okay, in this market, it looks like I'm getting some really good assets at very good prices. Instead of prices going up, we have this dislocation in the market, which is probably temporary, which gives us this window of opportunity to go in and buy a lot of these assets at really cheap prices, because
it's an opportune time to be buying.
Yeah.
There's still uncertainty in the market, which, as you say, and Warren Buffett said, is when you want to be buying.
I love uncertainty. I think that's when we need to buy, and that's when I've seen you make the most amount of money, because everybody else is selling. Hi and welcome to the first episode of the PropShare Podcast series. Today we are in conversation with Ben Cassey, who is the founding director of Inflection Real Estate, a UK-based property company who work with investors, property owners to provide exceptional returns on the UK commercial real estate market, and in particular the logistics and warehousing asset classes. I've known Ben for close to 2 years now, and we've been working very closely in developing a UK portfolio of warehousing assets, of which we've already acquired 2, and we are in the process of acquiring the 3rd. Ben graduated from the University of Bristol in 2004, and he did his MSc from the University of Edinburgh in property investment and management. And he started off his career as an analyst in Goodman and spent close to 9 years at First Alliance Properties, managing real estate close to £350 million. In 2019, he started Inflection Real Estate, and since then, he's been working independently with property owners and investors like ourselves in sourcing, managing, and actively selling commercial real estate properties in the UK. Great. So I will let you introduce yourself, and then we can kind of dive into maybe your experiences at First Alliance, where you spent a considerable amount of your time, to just see what you've been up to and what you did there.
Yeah, sure. Well, firstly, thank you for having me here today. So I set up Inflection Real Estate at the end of 2019, really to focus on UK commercial real estate opportunities where we perceive there to be a supply-demand imbalance. Particularly, we have targeted the industrial and logistics sectors and retail warehouse. These seem to have the strongest supply-demand imbalance across the UK commercial sector. So there's me and my business partner, Richard Worrell, who I've known for a number of years, and he joined me mid-2020. So together we form a pretty strong team, and we've got 2 advisors who we've both known for a number of years. Prior to setting up Inflection Real Estate, I worked at UK property company First Alliance Properties, which was founded by 2 very experienced UK commercial property operators who built their own portfolio up in the early 2000s in the industrial and logistics sector. In the financial crisis, they decided that it was a very opportune time to build up the joint venture book, which is when they brought me on in October 2010. So we built up the joint venture portfolio from 0 to 350 million over a period of about 5 or 6 years. We had joint venture partners such as JP Morgan, Rockspring, Evans Randall, Sedco, which is a Saudi economic development company. And these were predominantly retail warehouse and logistics deals ranging from 15 to 25 million. We successfully exited all joint ventures by 2019 and delivered an ungeared IRR of 15% to all our investors. So everyone was very happy. All the investors received exceptional returns.
And the portfolio, sorry, interrupt you, was mostly European based, right?
That was all. No, it was all UK.
Oh, it was all UK.
Yeah,
okay.
that was all UK. But prior to working at First Alliance Properties, I was the analyst for the Goodman European Logistics Fund, which is based in Brussels, and that was a 1.6 billion euro fund comprising 91 core logistics assets across 11 countries in Europe. So I was the dedicated fund analyst, analysing all the fund metrics and the property metrics, reporting to the board in Sydney.
And
so
this was also the Lehman Brothers crisis,
exactly
2009-10, right?
I actually started the week that Lehman Brothers went bust, so it was a very interesting time to be starting. The share price of Goodman, like a lot of real estate companies at the time, fell massively. I think it fell from $7 to 15 cents overnight. So we had some very interesting conversations with the Goodman banks, but we managed to ride out the storm, and we bought some great deals in the depths of the financial crisis. The Goodman model is very interesting because they, in addition to buying stabilised assets, also have a development arm, and the funds have a first right of refusal over everything that the company develops.
Right.
So they know that they've always got a good buyer for their assets, and the funds know they've got access to very good off-market prime industrial kit. So it was a great business model, and it's grown hugely over the last 15, 20 years.
Right. So you've bought assets in Europe as well as in UK. You obviously have tremendous amount of experience in managing these assets. You've seen at least a couple of cycles in real estate, I guess, the 2008-9, which I also saw at Blackstone, and then the big boom that happened from 2010 to 17-18, and then the warehousing boom, which started in 2015-16 with the rise of Amazon and online sales, and which really peaked during the COVID-19 crisis. So, I mean, just tell us how this industry has changed.
So the industrial market 15, 20 years ago was predominantly, as you said, manufacturing-led. They typically weren't by motorway junctions, because when all those industrial estates were built, there weren't motorways, because motorways only came around in the 1950s and 1960s. So it was old, antiquated industrial estates, low eaves, small unit sizes, poor loading yards, often no offices or very low office content, really not purpose-built. And of the three core commercial real estate sectors in the UK, office, retail and industrial was always the unfavoured little brother, basically. Investors in the 1990s and early 2000s always wanted office and retail, but there's been, as we all know, a huge structural shift, which has only accelerated from COVID, and that shift has been predominantly onto online retail and also remote working.
Yeah.
So office demand has really fallen off a cliff. So offices are quite out of favour. Retail, as we know, high street retail in the UK has been really badly hit with the shift into online retail.
Like anywhere else, yeah.
And UK has got the highest penetration of online retail in Europe, 30%. So it's a really strong story for logistics.
So when you say 30% of all sales happen online.
Exactly.
Yeah, in India that number is in the low single digits. That of course is also why people see such a big opportunity here.
And it's not that there isn't a manufacturing sector in the UK, there certainly is, and it's still very buoyant. But typically manufacturing operators will be in the older kit with lower eaves, more supporting columns. The loading yards aren't so important, whereas the logistics warehouses are the warehouses by motorway junctions, higher eaves, good loading yards, 10% office content. So it's a two-tiered market, which is great because they both help support each other in terms of value and occupier demand.
Right. So when you started buying warehouses in First Alliance or managing them in the earlier part of your career, I guess it would have been mostly manufacturing units. But did you see like a change over the last few years of your time there into more retail, logistics, where higher eaves, I mean, when Amazon comes into any market, they bring with them their entire processes, technology. They want really high eaves and so on. So I mean, they were definitely one of the key drivers to changing the layout of warehouses everywhere.
Definitely, and actually, Goodman were ahead of their time. And on the continent, we were building massive, great high eave, sort of 500,000 square foot logistics warehouses all around Europe. And then First Alliance, we focused a bit more on the older kit initially. So we bought a big industrial estate, a multi-let industrial estate with some manufacturing in it with what's called North Light roofs. So if you see those roofs that are jagged roofs and they have skylights in them, so they're faced north, so they don't get direct sunlight from the south. It all comes from the north, so it keeps the light out. And that's considered secondary in terms of specification.
Right.
But we bought one of those in about 2010, and we did a light refurb, but we sold it to a pension fund, Hermes pension fund in 2015, and we did pretty well out of it. But that now would be considered pretty tertiary kit, and you wouldn't be selling that to a pension fund, so it wouldn't be institutional. So in answer to your question, yeah, it really has changed. If you want to be exiting to an institution, which is what we always focus on with the PropShare assets, you've got to really be going for a modern specification.
Right, right. And in terms of yields, how has that changed over the last 10 years? Because like you said, it was out of favor in the initial part of the late part of 2009-10. So if I wanted to buy a warehouse then versus now, what would I have to pay for it?
Well, it's changed a lot in the last 6 to 9 months, as we know. But in the last 10 years, as I said, industrial was always the less favoured sector. So offices or retail, either high street or retail warehouse, would typically be 100 to 200 basis points sharper yield than industrial. So industrial was always the highest yielding sector.
Yeah.
So whereas a prime office might be 4%, a prime industrial unit in 2010 might have been 6%.
Right.
But that really turned on its head and really accelerated during COVID. I mean, prime industrial went down to 3%. Prime offices in the city were probably around 4.5%, 5% then.
So it went down below prime office.
Yeah,
right.
Way below.
Yeah.
Some of these warehouses that were 20 years to Amazon, a year to 18 months ago were 2.5% to 3%.
Wow. Okay.
So those purchasers have got their fingers burnt.
We've seen some of them ourselves, right? When we went to buy some of these assets last year, we saw pretty crazy prices, 3.5%, 4% for warehouses that were not really high quality, I mean, but decent quality, but still, I mean, it looked quite expensive when we went and looked at some of this stuff, and then we said, look, this doesn't make too much sense. Let's wait for some time to see whether this corrects a bit.
So the yields have moved out of all sectors relative, because the gilts and the risk-free rate has moved out because of what's been happening with the base rate.
Yeah.
So all sectors have moved, the yields have moved out, but industrial is still sharper than offices and retail.
Right. If I were, just touch upon a little bit on the type of warehouses that we typically find in the UK. I know we've looked at all of them, but there's manufacturing and logistics that you spoke about, but there's also retail warehouses. How are these different from traditional logistics or manufacturing warehouses?
Well, to look at, and in terms of construction, they're pretty similar to warehouses. They're a steel-framed, overclad, steel frame structure basically, but they have a different planning use, they have a retail use, and they're typically located in retail locations rather than logistics locations. So high prominence to footfall and lots of cars coming past, so often on the edge of town. Out of town retail is the other name for it.
Right. And they're typically larger parks where there are other tenants close by, right?
Yeah, exactly. They like to group together. So you might get a retail park with 10 or 15 tenants, and they typically you get open A1 fashion, which is one planning use. You also get the discount retailers. You get a range of covenant strengths, so you get some really strong covenants like B&M, which we know very well because they're the tenant in Greenock. That's probably the strongest discount retail covenant in the sector, 4.4 billion turnover last year.
Right.
But then you get some weaker covenants that you really want to steer clear of, such as Matalan that we've been avoiding, which actually announced it was going into administration last week. So it was good we avoided that one.
Yeah.
Carpet right is another one. A lot of these companies, they load themselves up with debt, private equity backers, and then when sales fall because of cost of living, what have you, for example, Carpet Right is a home furnishings company. They do carpets and sofas. In a recession, that's typically what people don't need to buy. It's not a necessary item. So those typically perform badly in a recession. So you get quite a mix of occupiers in the retail sector. The one thing you don't get in the retail sector, which you do get in industrial logistics, is rental growth projections. There's not that supply-demand imbalance. So it's slightly higher yielding on the way in, because you know you're not going to enhance that yield so much throughout your business plan.
Right. So, I mean, if we look at a retail warehouse versus a logistics, what do you think typically is the difference in pricing?
Good question. So I think retail warehouse is probably, it depends on the location, but there's a definite discount in the yield, because if you're buying, for example, the warehouse we're looking at in Leeds that we're currently in legals in, the initial yield on that is 6.25%, but it's because it's got rental reversion. There's a rental uplift in August 23, and that's likely to go to around 7.3%. Whereas if you're buying a retail park, your income will probably be flat during the business plan because there's just not the rental growth in the sector.
But your going in would be slightly higher.
So you want to go in softer. So
right.
Rather than going in at 6.25%, you want to go in at 7.25%, 7.5%, because your income's going to be flat. And you basically need more on the way in to make it attractive, because you're not going to get that rental growth throughout the business plan.
Right. And while we're on that, can you also explain how tenancy works in terms of how long are the leases normally in the UK, and how does an owner or an investor get returns in terms of escalations on the rent? I'm talking from a very Indian perspective, where we have a triple net lease, 3+3+3. It's a 9-year typical lease. The tenant is only locked in for the first 3 years. He can leave after 3 years. But the landlord is locked in for 9 years. And the reason that is because the tenant in India mostly ends up spending a lot of money on the fit outs. When an office building is delivered in India, it's like a garage. There's nothing. There's no flooring, there's no ceiling, there's no lighting, there's absolutely nothing. And the tenant has to do all of this himself. And this can cost used to cost around $60-70 per square foot, but today it costs $150 a square foot very easily. And tenants sometimes spend a lot more than that. So when tenants spend that kind of money, they don't want to be in a position to be asked to leave after 3 years or 4 years. And from the landlord's perspective, they want someone who's not going to leave in at least 3 years. So that's why we have a 3-year or a 5-year lock-in from the tenant side. But the landlord can't throw the tenant out for 9 years. But it's quite different in the UK, right? Yeah,
it's typically a 5-year structure. So it's either 5, 10, 15 years. And it's usually a mutual break, landlord and tenant at year 5 or year 10. You obviously want as long a lease term as possible, as strongest term certain you can get. The rent review is typically done to open market value. So that is done by comparable rental deals that have been done in, say, the last year. And you have a surveyor who acts for the landlord and a surveyor who acts for the tenant, and they agree a schedule of comparable evidence what the appropriate rent is. If it can't be agreed, it goes to arbitration. You have an arbitration surveyor who agrees based on the evidence provided.
Right.
There's a continual shift towards the European model, which is an inflation-linked rental increase. So in France, they use the construction price index. In Germany, they use the same. And in the UK, we're seeing more and more leases that are done to CPI, the construction price index, usually with the collar and cap. So, for example, the property we bought in Greenock has a 1% and 4% CPI collar and cap. So it can't go above 4% per annum, but it can't go below 1% per annum. The property we bought in Preston, I think, has a very attractive lease review structure, because that is the higher of open market value, or 1% and 3% CPI. So with inflation where it is, you're almost certainly going to hit the 3% cap per annum. But open market rental value could be a lot more appealing, because we're seeing double-digit rental growth per annum in the northwest. So over the next 5 years, that could really outperform the CPI. So it's quite a nuanced structure at the moment. The traditional setup is open market value, but we're seeing more and more CPI reviews.
Right. So basically there are, from what I hear you, two types of reversions. One is just to market. Let's say after 5 years, we go back and see what the market is, and if therefore the market is higher than what you were paying, then we agree on a price, and then we move on. And if the price is lower, there could be a floor, or we could just have a lower rent, right? That's how.
Well, it's usually nearly always upward only, so the rent can't go down.
Okay, so
it's a very landlord-friendly law.
Right.
So it's upward only to open market value. So even if rents fell 20%, you have a floor. Your rent can't fall.
So in such a case, the investment manager has to take a call on where the market is headed over the next few years, and that's the reason you're talking about this supply-demand imbalance, right?
Exactly.
Because if there's no supply and there's a lot of demand, then the rents are bound to go up. Therefore, it makes sense to buy assets which revert to open market rents.
Yeah, if in a strong market, yes.
Whereas in a weak market, you would prefer to go with a cap and collar structure.
Yes.
Then the second one, which is the cap and collar, is directly linked to inflation, right? So higher the inflation, higher your rent, lower the inflation, lower, which is great, because one of the reasons we buy real estate is so that we have returns which are linked to inflation.
Yes.
And therefore, when the cost of living goes up, like it has in the UK for sure, and in most of the Western world, in India it's still not that bad, but when inflation goes up, your $100 which buys a basket of goods today will end up buying much lesser 4 years down the lane. But if you invest that in a real estate asset which is directly linked to inflation, then you would probably end up with the same basket of goods even after 4 or 5 years.
Yes, you'd hope so. Real estate's usually seen as an good inflation hedge, especially if you've got that rent review provision to open market value and higher CPI.
Okay, Ben, if you can talk a little bit about what are the key drivers for UK logistics today. When someone looks at UK logistics, why is it doing so well today?
I think to answer that question, we need to split it out into the occupational and investment side.
Right.
So from the occupational side, the key driver is the supply-demand imbalance, which I've said. Currently, vacancy in UK logistics is 3.5%.
Okay.
But take-up last year was 56% above the long-term average and the third highest ever. So this is translated immediately into rental growth.
Yeah.
In the 12 months to August 22, rental growth across UK logistics was 13%.
Wow.
It fell slightly to November 22 to 11%, but still, compared to the MSCI long-term average from 1987, is only 2.6%, so we're way above the long-term average. So there's very strong rental growth drivers behind the market. And the reason for this, so there's a lack of supply, and the lack of supply is driven by the fact that the UK is pretty densely populated. They have strict planning laws, so there's not enough land allocated to commercial use. And also you're seeing of that limited land lost to change of use, because although values have gone up a lot, it's still the lowest value use in a lot of places like London, Birmingham, Manchester, Leeds. So where possible, developers are getting consent for residential or other higher value uses. So supply is really, the UK logistics is in very short supply. There's strong demand. As we've mentioned, UK has the highest online penetration, 30%.
And obviously building is not easy one, because there's not enough land compared to India. If you look at India, there's a lot of land, so it's very easy to build warehousing. And since warehouses, they are not as complicated to build as office properties, which could take 3-4 years to build an office building. You could get a warehouse up in a year and a half.
Yeah.
One is there's not enough land to build these warehouses, and second, just the cost of building these warehouses are quite high these days. Right?
Definitely, and in the last year we've seen build costs increase hugely. So as yields have gone out as well, this means land values have fallen dramatically. So in the northwest, prime industrial land values fell from 2.6 million last year to currently around 1 million.
Okay.
So a lot of vendors just won't sell their land because they want to hold on because it's fallen so much. So unless they're a forced seller, they won't sell.
Right.
So with high build costs and a lack of land, a lot of development is just unviable now.
Yeah, and if you do build, you need to just price it much higher, right? The rent
Exactly.
has to go up. Otherwise, the developer is not going to make the margins that he would have normally made with this or any other asset that he would have built.
Exactly. So you wouldn't spec build industrial in most of the UK now, but you would if you had a strong pre-let to say an Amazon for 15 years, then the numbers would stack up. So spec development has really dropped off.
Okay. And when we talk about investing in the UK today, the first questions people are asking, of course, you've seen 3 prime ministers in the last 6-7 months, right? There's a cost of living crisis, there are kind of strikes, it's almost reminiscent of the 1970s and 80s. The pound has depreciated quite a bit, the highest in fact against US dollar for 25 years. I mean, even against a weak currency like the INR, where the GBP has been appreciating every year 3 to 4%, just like any other Western currency, just given the fact that India runs such a large current account deficit. Even the Indian currency appreciated against the GBP from close to 100 to 88 rupees over the last 6-7 months, but then slowly started going up again. So, it kind of seems counterintuitive to be buying something in the UK. So why do you think it's such a good time to enter the UK right now?
Well, as you said, it's been very uncertain times. We had 3 prime ministers and 4 chancellors in 12 months. Inflation went to 11% at the end of last year. Interest rates rose to 3.5%. But I think investors are beginning to think things are stabilised. Inflation has come down from 11% in November to 10.7 in December to 10.5 in January. Yeah. And I think investors are beginning to see the light at the end of the tunnel. If you look at the listed REITs, Segro, the big box Tritax REIT, they've both gone up 11% over the last year, whereas the FTSE All-Share Index only went up 4.7%.
Right.
So we're really seeing, a lot of investors are beginning to see the bottom. I think things are stabilised. Rishi Sunak has been great. Yeah. He's really bought, I think both sides of the political spectrum are confident in Rishi Sunak. So him and his government have really helped stabilise the situation. So right. I think it's a relatively good time to be buying. You've got these funds such as Threadneedle, these open-ended retail funds meeting redemption requests. So they typically sell at the wrong time to fund their redemptions and then buy back at the top of the market.
I mean, when I look at my experience at Blackstone and Blackstone in general, and the way they've been able to provide such stable above-market returns for 40 years to investors, 18-22% IRRs, and then my own time investing there in 2007-8, which was really, like we were just discussing, a pretty tough time to be in investing. I mean, what we saw there is, look, the market can change quite a bit. Sometimes it's quite volatile. Sometimes it's really hunky-dory. Everyone wants to buy stocks and real estate and so on. But that's not the time when you want to be buying these things. Like we mentioned, a year ago, these assets were trading at 3.5%. So if you had bought then, you'd be down 50% from your purchase price. Whereas if you time your investment decision correctly, at the time when people are fearful, like Warren Buffett says, that's the time to be a bit greedy, and then you kind of see, okay, in this market, it looks like I'm getting some really good assets at very good prices. Yeah. And if the fundamentals of that industry are strong and they're going to do well, then I shouldn't be hesitating in buying more. Now, fundamentally, we know that the logistics market in the UK is very strong. There's no demand, there's no supply, there's a lot of demand. A lot of people are moving to online sales. The need for warehousing is really strong, but there's not enough warehouses. But instead of prices going up, we have this dislocation in the market, which is probably temporary, which gives us this window of opportunity to go in and buy a lot of these assets at really cheap prices, because inflation can't be 10% for 5 years, because that'll just demolish the economy. Interest rates can't be 4 or 5% forever. Then it'll be impossible to buy houses. There'll be a huge housing crisis. If we look at the history of countries and economies, interest rates and inflations have never stayed really long, unless you go to some South American countries which really are facing a lot of issues. But otherwise, if we take a call that, look, it's a first world country, it's one of the largest economies in the world. Now we have a stable government in place for the next year, couple of years. If interest rates and inflation come down, we might be in a situation where we have these great quality assets at 6.5%, which we can actually sell at 4.5%, 3-4 years down the line. That's where the real value is, right?
Definitely. We're buying at an opportune point in the investment cycle. And using Preston as an example, that we agreed a price in October at 6.5% yields. Earlier in the summer, in July, it had been under offer at 5.75%, and yields had already softened by then. So it's very probable that you could exit that at around sort of 5.25% in a good market, having re-geared the lease to the tenant. So whereas before, at the top of the cycle, you couldn't really underwrite sharp yield on exit because yields were so sharp.
Yeah.
Now you really can be buying soft yields and underwriting the sharper yield on exit. So it's a really good, it's an opportune time to be buying.
Yeah.
There's still uncertainty in the market, which, as you say, and Warren Buffett said, is when you want to be buying.
Yeah, I love uncertainty. I think that's when we need to buy, and that's when I've seen you make the most amount of money, because
Definitely.
everybody else is selling, and you are buying best quality assets with 10-year long leases, and most likely you're going to be on the other side very soon, where you suddenly have, like I said, a portfolio of really good assets. If we look at, we've talked a lot about the market and the UK, but drilling down to the basics of investing in warehousing, what are the 4-5 factors that are critical when you look at buying a warehouse in the UK?
Okay, well, starting off, I think location is key. The one thing you can't change is the location.
Yeah.
So typically, industrial logistics, particularly logistics, you want to be by easy access to the national motorway network. So the asset we bought in Preston was a great example of this. It was on the junction of three motorways, the M6, the M61 and the M65.
Yeah.
So it's a cracking institutional industrial estate, which is really well located, because tenants typically look for journey times to their consumers. So the closer you are to the motorway, the more efficient the business is. So that is a pretty key criteria. Lease term, if you're an opportunistic investor, and you've got rental growth, you want to be buying short income, looking to re-gear the lease and add value. If you're more cash on cash motivated, you want to be buying secure long-term income with a rental uplift during the business plan. What else? So lease, and you
tenancy, I guess, also, right?
Yeah,
the covenant, how strong he is.
The covenant's very important. So both deals we've done to date, I mentioned B&M, 4.4 billion turnover last year.
That was a great covenant.
Camac in Preston, their turnover has just gone from 60 million in 2021 to 90 million in 2022. So an improving covenant is great, because that sharpens your yield on exit, because investors like a strong covenant. So covenant is very important. Specification of the warehouse is increasingly important. So whereas I talked about old manufacturing units have become obsolete, now a modern unit, so the things people look for are location to motorway, these high eaves, good loading yard. You want at least 20-meter loading yard. You want about 10% office content. You want dock level loading doors, ideally, rather than level access loading doors. You want to have, what else on the specification? Sorry.
Maybe also, I mean, I've seen in most of the stuff that we've bought, there's a small office in there, which is quite helpful.
10% office is the norm. You don't want to be over office, you don't want to be under office, but tenants typically like to have about 10%. Another important aspect, and increasingly important, which I haven't touched upon, is EPCs, so energy performance certificates. So there's a lot of regulatory change internationally, but in the UK, the latest legislation stipulates that every commercial property must be an EPC of B by 2030 and C by 2027, which is not long in commercial property terms. So typically warehouses built between the 1990s and the 2000s are an EPC of C to E. So you want to be buying properties that are either a B or a C or just below, so that you can undertake some initiatives, asset management initiatives, to enhance the EPC, because otherwise the property will become obsolete.
And obviously we have the couple of things we look at when you're looking at real estate anywhere in the world, which is your rent versus the market rent, how far off you are. You don't want to be above the market at any point of time. You want to be as much below the market as possible, so that the tenant doesn't move for rent. And the discount to replacement cost, which we spoke about, right?
Definitely.
We want to make sure that if today this warehouse was demolished, the land was bought and built again, it will cost a lot more than what we are buying at.
Exactly. So that's a key criteria, and you see that more and more as land values have increased, but your vacant possession and build costs have gone up. So you could typically be buying a warehouse for £65 a square foot, but the cost to replace it might be £90 a square foot. So that disincentivises developers. Okay. And in terms of the lease, you want to be looking for an FRI clause in the lease. So you want to have a full repair and insure. So the tenant has to reinstate the property back to the condition it was when they took the lease. And often there's a carve-out of schedule of conditions, so certain items are excluded. Ideally, you don't want that. But another aspect of the lease is the alienation provision. So you want to make sure that the tenant can't assign the lease to a weaker covenant. So you don't want to let your property for 10 years to Amazon and then find they've just assigned it to another group company that's of a lesser covenant.
A sublease is how we refer to it. Also, what I really liked about buying UK property is on the lease, in India, we have all sorts of expenses at the SPV level. You have to pay property taxes, insurance, and lots of other expenses that kind of keep coming up. They eat away some of the returns. But in the two assets that we bought, it's absolutely clean because the tenant pays for insurance, the tenant pays for refurbishment. They even, like you said, they have to give you back the warehouse in exactly the same condition that you gave it to them. So in a way, you don't even spend capex at the end of 15-20 years.
Exactly. It's basically their warehouse for the period of the lease. They have to look after it and give it back to you how they started the lease. And they have to ensure that, the landlord actually does the insurance because you can't have a risk of your property not being insured. So the landlord insures it and then charges it back to the tenant. So your cost should be minimal. Okay.
Before we close, let's speak about the two warehouses that we've purchased for the PropShare platform. The first one, right up in Scotland, the B&M Greenock. Do you want to speak briefly about that one and why we like that one?
So the B&M in Greenock was a discount retail unit. It's well located in the centre of town. It's in a prominent position right by the main bus station. It's a tertiary or secondary town, but it's very good for discount retail because the demographic is very well suited to B&M.
They do really well there.
Yeah, and the unit trades very well. It's got a 10-year lease with an RPI uplift of 1% and 4%. So we bought it for 4.4 million, equating to a 7.1% yield. But in year 5, assuming that inflation averages at 4% per annum over the next 5 years, which it's likely to do considering for the first year will be at about 10%, we will hit 8.7% reversion yield. So your 7.1 jumps to 8.7 in year 5. So it's a really strong covenant. It trades well, it's a prominent unit, and it's also a full repair and insure lease, so the tenant has to give it back to us in the condition they found the property at the beginning of the lease.
They've actually been there for 20 years.
They've been there for a long time. They're long-term commitment to the unit. So our business plan is to re-gear the lease towards the end of the 5-year term. So we say to B&M, look, we know this unit trades well, you've been here for 20 years, can you give us another 10 years on the lease? And we might have to give them a rent-free period or have a conversation about the rental uplift to try and maximise value.
And we've also been looking at lots of asset management initiatives here. We're trying to put in like some electric vehicle charging units here and a drive-through. Maybe you want to talk about a little bit about that?
Yeah, sure. So the asset management, because the tenant, as I mentioned, has the property for the term of the lease, any asset management we do on the site has to be done with the permission of the tenant. So we've been exploring EV charging points because there's surplus space in the car park. And we've been in liaising with SSE power company who've expressed an interest in providing 10 EV charging bays, and they would pay £2,000 per bay per year. We would have to share this revenue with the tenant to make it worthwhile for them. But we think it could be a good draw to the unit and it would help enhance the income. If we can't do EV charging, we will explore potential for putting a drive-through on at the entrance to the estate.
Right, and if you were to talk about how investors will make money in this asset, it's the 7.1% obviously which we make for 4 or 5 years, and which bumps up to 8.5% or more after 4 years. And then when we sell to someone, that someone still has 5 years of B&M left, a very strong covenant at that point of time. And what you're saying is we could even negotiate another 10-year lease with them and sell a 15-year lease, which is obviously very valuable to any cash buyer who buys for cash on cash yield. And then we could get a much lower capitalization rate on exit.
Exactly, and that's your typical exit. That would be the great outcome. If we could get 15 years, I think 10 years would be more likely. But if we could get a 10-year term, so we'd re-gear for an extra 5 on top of the 5 that's already there, in exchange for, say, a 6-month rent-free, and then when you come to sell it, you top up that rent-free to the purchaser from the sale proceeds. So it's that's the aim of what we're going to do. And we're in a great negotiating position because we've got such a big rental uplift in year 5.
Yeah, and I love this asset. When I went up there, it was very busy. The tills were kind of full, lots of people buying stuff. And like you said, discount retailing does really, really well during cost of living crisis.
It's a very recession-proof business, and that was evidenced by the financial crisis. B&M and the other discount retailers really traded so well. A lot of them made their names during the financial crisis.
Yeah. If we were to talk about the second one, which is the Walton Summit, now very different asset. Once again, when we walked it, as soon as we saw it, we were like, look, this is a great asset. The location was so good. There was less than 1% vacancy, institutional ownership all around, lots of pension funds, REITs owning assets, very close to the motorway, and a pretty good covenant, which now has ended up becoming a very strong covenant after the latest numbers.
Exactly, yeah. It's a great institutional asset. We bought it off Threadneedle for one of their pressured sales from their redemptions. It's on an institutional estate close to the national motorway network, meeting of 3 motorways. Threadneedle overclouded the roof in 2018, so we've got a 40-year guarantee on the roof. It's a great yard, great loading yard, as I mentioned earlier. One of the key attributes of a good warehouse, you want to have a good loading yard. It's a 10-year term from February 22 with an CPI, not retail price index, construction price index review of 1 and 3 in year 5. So we bought it for a 6.5% initial yield, and that should go to about 7.5% in year 5. So it's a great institutional asset, as you say, in an institutional industrial estate.
And the play here, this is a straight up opportunistic investment, because here what we are saying is, look, the seller was distressed. He had to meet redemption requests from investors, and therefore he tried to sell it at 5.5. He couldn't. The sale fell through with a private investor, and he came back to us and we said, look, we're going to buy it off market, but at our pricing, which is 6.5%, which I was surprised he agreed towards the end, which is good. But here, all we're trying to do is hold on to this asset for 3-4 years, wait for the covenant to improve, and then either sign a slightly longer lease with him or just exit off a lower yield and make money.
Yeah, and I think the covenant should have improved. So I went to go meet the tenant a couple of weeks ago, the executive director, and we were talking about their recent financials. So they've just announced turnovers increased from 60 million to 90 million in the last year. They're very acquisitive, a hugely growing business. They're looking for 5 new sites in the next year.
In fact, they even spoke about trying to get a longer lease in for a rent-free.
Yeah, they've already mentioned that, so we could give them a longer lease for a rent-free, but I don't think we want to do that until we want to exit.
But at least it tells us that they are interested in staying in this place for longer.
Exactly.
They are not looking to vacate this place. The business is doing well, and they are most likely going to stay here a little longer.
Yes, and they want to spend some money on the office block reconfiguring, so taking out some dividing walls and making a more open plan so they can use the office more to their preference. So they're definitely committed to the location. It's also, I should mention, now got bonded warehouse status, so it means that they can hold VAT goods without paying UK import tax on them. So it's great. You can import the goods and then export them without having to pay tax. So it means they have to have higher security, so they're improving the security fencing, which is another great attribute for a warehouse. Everybody wants a secure warehouse.
The more money they spend, and the better it is for us.
All at their cost, exactly, so it's great.
It makes them stickier and they kind of hang out.
And it helps your reletting prospects.
Exactly.
Yeah.
I think we've covered most of the stuff. Thank you so much for helping us kick off the podcast series. Ben, it was a pleasure speaking to you. And thank you so much. And I look forward to working closely with Inflection over the next few years and building out a portfolio of 100-200 million pounds worth of warehousing and retail assets.
Well, thank you very much for having me today. I think it's very exciting, the opportunities in the UK market at the moment, so I look forward to capitalising on that with PropShare.
Great, thank you so much for joining us, and we will see you again in the next part of the series where we will be speaking to some really interesting people from the industry. This time we had Ben over from Inflection. Over the next few episodes we're going to have a lot more industry experts talking about commercial real estate, the market, and various other drivers that drive investment in rent yielding real estate. Thank you so much.